Hey everyone, this is Michael, and this is the Market Trend Advisory video for February 13th, 2022. I'm going to make this video pretty quick. I'm just going to go over the current market trend overview. But before I start, just wanted to say the content and information in this presentation is provided for educational informational purposes only, and in no way should be considered investment advice. So let's go ahead and just take a look at what's happening with the market trend. Well, from last week, we had a pretty strong uptrend in place, and it deteriorated last week, especially on Friday, actually Thursday and Friday, and we're now into an uptrend uncertain, uptrend under pressure status. And the NASDAQ especially got hit by a number of institutional selling days, and our market count system actually went down to 0, so we're back to no exposure for the NASDAQ. And with 3 institutional selling days, so it's not good. The S&P's holding up a little better, though it's got hit by some institutional selling days too, but we are still have some exposure, 55%. It's mostly because it's being held up by a lot of the big Dow companies, cyclical companies, some of the more industrials, which are holding in there, and some of the mega caps too. But overall, the picture is deteriorating. So let's take a look here at the NASDAQ. From our peak on here at 16,212 down to the bottom where the market did a really strong reversal, the market almost went down 20%, which is the definition of a bear market. So it's almost as if when it got to that low, the players in charge and the big players just said, no, we can't have a bear market. It can't go down 20%. So let's just jam it back up. And then we had a follow-through day on the 6th day. This day here was the first day of an attempted rally. And then we finally got a day with stronger volume. Right here you can see it. It wasn't really strong, but it was a follow-through day. And then since then we've been struggling with what's to make any headway. We're still below the 200-day moving average, which is the black line, and we're in a downtrending 50-day moving average, which is the red line. So technically the market doesn't look well, and it's no surprise that our system has at 0 exposure, and we're basically out. So one thing I wanted to mention before I move on is historically, when you get this much distribution or institutional selling days, within a week of the follow-through day, it usually kills the rally. I think when some of the stats are, if you start getting institutional selling days right after, like within 1 or 2 days, that's like 80% of the time, even higher, the rally just dies. It just couldn't really get going. So this is it's a warning sign. It's not a good sign that we're seeing this much distribution coming in, and we're struggling to we're just about to break below the follow-through day. So not a good sign. So the S&P 500 is holding up a little better, though we did break below the 200-day again on Friday, and we've had two institutional selling days. And this one, at least the 200-day, is still rising, though it's starting to flatten out, and the 50-day is declining, but it has a little bit of a curve to it, to the upside. So it's better technical situation, but still doesn't look good, and you can see why the market's been struggling. So here we can see just some of the technicals. We're back to having all the major indexes below their 200-day moving averages, and below the 50s, and technically it's really hasn't been very strong for a long time. This is about 3 weeks of data. Briefly, S&P, you can see got above the 200 when it was trying to show more strength, and it just basically it's failed as of Friday. Here you can see just the technicals in this red lined box here. I mean, we're looking at almost a month of trading, and the vast majority of 52-week lows are outpacing 52-week highs. At one point here on the January 21st and January 24th, I mean, we kind of hit a panicky low here, and of course it came up off of that, But we're just in even this last week, we're starting to just again have more 52-week lows than highs. It's not a strong picture of what's going on under the surface. And then finally, we have this chart of the Nasdaq. 80% of stocks are below their 200-day moving averages. That's a very weak market, and that's basically a bear market under the surface, as we've talked about in other videos. And this has been going on for about a year now. So really, this the market's in trouble here. Whether it can continue higher and make a new high that's the big $64,000 question. So just in summary, we're seeing just a lot of volatility. It continues to be really high. Risk is high, and caution is really the best foot forward at this point. The indexes have tried to rally, but they've run into trouble. And really, it's a dangerous market with a stealth bear market going on under the surface. Another part is really disconcerting is there's very little participation. Nasdaq stocks, which are generally the ones that are driving the market, are mostly in downtrends or bear markets, and there's just a few sectors, which are the cyclicals and oil and shipping, some chemical stocks. They're the only things participating in the rally. I mean, on Friday, really the only things that made any kind of move were oil and gas stocks, and really not much of else is really even attempting a rally. And we did have last week a pretty strong snapback in a lot of the beaten down tech and growth names, but that appears to have run out of steam. Again, not a great sign. So overall, the market really is in need of a lot of repair. Just going back to that Nasdaq chart, I mean, we're nowhere near highs anymore, and we've almost hit bear market territory. So it's unlikely we're going to see a return to the rip-roaring bull market we saw in 2020 and at least in the indexes for the early part of 2021. So that's probably not going to come back for some time. The market just needs to regroup and at least end the downtrends in a lot of the former leaders and stabilize. And we also still have the mega caps holding up the averages. If they fall as the final dominoes, we will see the Nasdaq and S&P go down pretty significantly. All in all, what's driving all this is we have issues with inflation, interest rates, direction, and rate hike frequency. Those are the key things to watch. The market is just very concerned and nervous about what's going on. Last week, we had the CPI report came out, and inflation hit 7.5% in January, the highest in 40 years. That's kind of freaked out the market. They weren't expecting that much inflation. And then we've had Fed President Bullard come out, and he's been becoming more and more hawkish. So he's now calling for a 100 basis point increase by July 1st. The market just a few weeks ago was looking at 1 or 2, very low basis point moves. Now it seems like we may have a much bigger problem on hand, and we might be seeing a lot faster rate increases going on. So really the key question is the Fed going to have to engineer a recession that will result in a bear market for stocks? That is what the market's worried about, and each report is being met with trepidation as to what it's going to bring. So those are the key things. Every week we have more reports that come in and to give a little bit more clarity to what's going on. So that's what we'll be watching for carefully this next week. We'll see if the market may just stick in this sort of a downtrend and try to fight its way out of it, or it may just fall apart, or probably not go on a big rally, but you never know. This is the stock market, and it sometimes does things that are not what you think or expect it's going to do. Okay, we'll be back next week with another video. Okay, thank you.